Making a smart purchase in real estate means that we're extremely satisfied with the results of whatever we were trying to accomplish. How do we know what a smart purchase is? How do we make a smart purchase, and what's really important? What I've discovered in this market is that most people are very scared of losing equity. That's their biggest concern. And I've heard over and over, I'm gonna wait until the interest rates go down. It's just too expensive. I can't get what I want. Those are extremely accurate characterizations of today's market. Last year, you're looking at a $600,000 purchase. This year, you're looking at $350,000. It's very interesting as to where the market has gone. But making a smart purchase can mean a lot of different things for a lot of different people. Some people understand, and I think it's very critical that you understand that if you are trying to purchase something moving laterally, moving up, moving out of a renter, or if you're looking for an area to place your money either for growth, preservation, or cash flow, those are very different goals, and making a smart purchase means that we need to dig into that data. The first thing that I think a lot of people don't understand is that the interest rates have an effect on values, but they're not tied one-to-one. There's a lot more data that goes into it, including jobs data, population growth, current population, and expected growth. I'm not going to dig into all of that, but I just wanted to show you the principles by overlaying historical inflationary data, the nationwide average home sale pricing, and the nationwide average 30-year fixed mortgage rate historically, so that we can get a good idea of what happens once inflation goes up, once interest rates go up, and where does that leave home sale prices at a national average. So if you look at the historical data that I pulled up, you can see that we've had 4 major inflationary events and then 1 deflationary event over the last 50 years. First event, back in 1975, the early 80s, the early 90s, at the beginning of the 2000s, and then of course, no one forgets of 2008. Now looking at these events, they all had different reasons for the issues that we face at those times. But you can see that as the inflationary data goes up in 1975, home values didn't do a thing. However, interest rates, they did go up. What does that mean for us? That means that we're paying significantly more to live in the same property, and the home values are unaffected. The same thing happened in the 80s. Inflationary data went up, home values did not change, but interest rates absolutely went insane. Obviously, inflation came down, prices continued to rise. We had this additional event in 1990 where inflation actually came down, values came down a little bit with that inflation. Now, mind you, over the course of the 90s, while the inflationary data continued to fall and the interest rates of homes were very volatile, but at a bird's eye view, they were trending downwards. Within the 2000s event, inflation pretty much stayed stagnant. Home values for a very brief period fell, but were very volatile. We had that 2008 event, which caused interest rates to fall. Home values fell significantly, more in certain areas and less in other areas. And inflationary data dropped off the map, and that was a job issue. A lot of companies went out of business because they were highly leveraged at that time. And that's, I think, a indicator that people need to follow way more than just CPI inflationary data in order to really get a grasp of what's going to happen or get some indications as to what's going on in the marketplace. This historical chart is not a small set of data. This is from the last 50 years. So if we're looking at what are we going to do in the future, what's going to happen in the future, home values in 10 years will be either at the same level as they are today or higher, unless we have another significant event. So what's going to happen in the future? In the next 10 years, are home values going to be higher? Are they going to be the same? Are they going to be lower? Well, based on this chart, every 10 years they get a lot higher. They come down after inflation very slightly, then they even keel off, and then they continue to rise. This event that we're going through now is based off of supply, demand. There's just no supply. There's a ton of demand. People need to provide shelter for their family. They need a home, whether that's renting or purchasing. And the majority of people understand that if you purchase something, those dollars every month are going towards something. At the end of 30 years, if you've spent the last 30 years paying your bills, then you own that house outright. And it doesn't matter as much if your home value is less or more, but obviously from these charts, your home value is going to be more, with more over 30 years. Population growth inside of the DC market is constant and phenomenal. The opportunities that we have here are great, and that's why we're in one of the most competitive markets in the United States. So purchasing a property, not worrying so much about the loss of equity, but worrying about, is this a good fit for my budget? I think is the more appropriate question for the individual that doesn't want to purchase today because they're thinking that next year it's going to be a better fit because of interest rates. It's a good way to not get into the game of real estate. Even if the asset that you're looking at is not ideal for you, you could still get into the game and use that purchase as a stepping stone to get to the next level. So how do we take this information and turn it into a smart purchase? How do we put ourselves on the best footing going forward? Well, we look at what asset class is going to be best for us moving forward, as in terms of growth, demand, where it's going to be in the future. And it really comes down to, like we've already been talking about, supply versus demand. What asset class can we put ourselves into that's going to have the most demand when we're ready to sell it, refinance it, do whatever our strategy involves. On top of the fact that after 2008, we went through that very sharp decline in valuation, the interest rate stayed at a very stagnant level. While you can see here, home values jumped up 30%. So it really is a case of, how do you put yourself in the best possible situation with our current interest rates, with what's in front of us? We have to deal with what is in front of us today so we can put ourselves in a great position in the future. Just take, for example, let's say you were looking at real estate in 1975. You keep seeing the interest rates jump up and up and up and up, and then you start to see them come down, and you're like, well, I'm not going to get into anything until interest rates get back down to 7%, 8%. Well, you're going to have to wait for 15 years in order for that to happen. And if you look at where home prices went from 1975 to 1990, they more than doubled. So don't put yourself in that position where you're thinking of waiting. You really just need to define what kind of property you want to get yourself into, what is going to be amenable to you and your family in a space that you're going to be able to enjoy. And once you make that first purchase, it's very easy to leverage that purchase into a much nicer home in the future. After the equity has improved, obviously you're paying off the debt every month, and it's going to put you in a much better position. So how do we take this data and make a smart purchase? Well, it really depends on what our goals are. Are we looking at preserving capital? Are we looking at growing our capital? Or are we looking at cash flow? Or are we looking at purchasing something in a great school district and we just want to make a smart decision? Well, if we're looking at the different asset classes inside of the DC metropolitan market, we're looking at very different price points, as well as condos, townhome, single family. And now we're coming to where we're going to start to see home values start to slightly decline, and that's a yearly cyclical thing. Over the last 2 years, it's been a lot more aggressive, so the demand has been a lot higher up, further along into the market. But historically, usually in August, we start to see a downtrend, and the bottom of the market is actually in December and January. It's a very cyclical thing. There's nothing to be worried about, but selling a home at the prime season and selling a home in the middle of the wintertime when most people are on vacation or celebrating holidays, not everybody's looking in that time frame. So I'd like to talk to the people that are still currently in the market looking for an opportunity. They want to make a smart purchase. And so what that means for you is going to be very different than the next guy or gal. But let's take a look. In condo sale, so with residential real estate, there really are 3 different types and then a few different segments. So we're looking at condos, townhomes, single family detached, and then there's different price points for those as well. 500 and below, 500 and up to about 1.1, 1.2. And then 1.2 million and upwards. Those are 3 different categories that we'd like to focus on because the demand for each is very different. And that's based off of the number of people that have certain budgets, which is very much affected by the jobs market as well as the population. So in the Washington, D.C. area, if you're looking at anything below 500, you are in the most competitive market that we have. You can see that last month to this month, we've dropped from about 74 to 72 on the home demand index. You're looking at above 500 up to 1.2. There's still a larger drop, but it's not as significant as the higher dollar. This is a very general demand index across the board for our entire area. Next, we have condos and then townhomes. And I'll say that the condo market is very interesting, but there are so many nuances in that condo market. And then also the townhouse market can also be a little bit nuanced. If we're looking at the market as general, condos are obviously way more prevalent than a single family detached and even townhomes. And that's because they're obviously inside of buildings. So if you don't know, inside of DC, the number of units you can have inside the building as well as the number of floors and are very much dependent on the zoning. And so the zoning for a specific unit or a specific type of property can also affect the value. If you're looking at highest and best use, something that has more development opportunity in the future is going to be valued at way more than something that has a limited opportunity, even if it's the same exact property that currently exists on that parcel. I think the DC market trends that are way more important to follow are what the unit looks like on the inside and the location. The location and the building it's inside is going to be a huge factor when it comes to whether or not you can realize some sort of equitable growth, as well as if you have made a smart decision when it comes to growing your wealth, being able to use it as a stepping stone. And that's something we can really go deep into. Because we live in such a high cost of living area, and obviously we're in the nation's capital, we have a lot of opportunity to buy something in a really good area or in a really good building that needs some work or that isn't the most updated. Renovate it after we've enjoyed it for 2, 3, 4, 5 years, and take advantage of the equitable growth of the neighborhood. And I'll give you an example. I sold a property earlier this year that a buddy of mine purchased. He purchased it for a little bit less than the guy that I sold it to. Mind you, this is in Foggy Bottom, one of the hottest areas. He put about 20 to 30 grand into it, and he was able to sell it for over $100,000 more than the guy that I helped purchase it. The condo was in decent shape. He turned it into something fantastic, and he was able to realize a huge gain just because of the current offerings that we have available. So hopefully you got some benefit from this. This is the market update. We're still in a very challenging market. The home values have dropped significantly in other areas, not our area. You need to focus on an area that you'd like to be in, at a price point that you like to be at. And if there is any sort of upward mobility on that valuation, I think we can find some nuance and opportunity. As long as you're looking at a property that really has some other intrinsic value or some other opportunity to capitalize on a characteristic of that property's location, layout, or expected change in a community. This is David. If you have any questions, feel free to give me a call. If you want clarification on any of the topics that I've went over or just want to chat about an opportunity that you're thinking about, whether it's buying or selling something that you own, please feel free to give me a call, shoot me a text, or send me an email.